Welcome back to Options Trading Mastery. I'm the Options Blueprint, and I am absolutely thrilled to dive into another exciting episode with you all today.
Hi, everyone. I'm Sarah, the Options Blueprint's graduate assistant. I've been investing in stocks for a few years now, but I'm still trying to understand why you're so passionate about options trading, Professor.
Oh, Sarah, that's the perfect question to kick off today's episode. You see, comparing options trading to standard stock investing is like comparing a Swiss Army knife to a regular knife. One gives you so many more possibilities.
But isn't stock investing safer? I buy shares, hold them, and hopefully they go up in value over time.
A common misconception, my dear student. Let me explain why options can actually be less risky in certain scenarios. With stocks, you're all in. If you buy a stock at $100 and it drops to $50, boom, you've lost 50% of your investment.
That's true. I've definitely experienced some painful drops in my portfolio.
But with options, particularly buying calls and puts, your risk is limited to the premium you pay. If I buy a call option for $5 and my prediction is wrong, the most I can lose is that $5 premium. Compare that to potentially unlimited losses with stocks.
Wait, that actually sounds less risky, but what about the potential for gains?
That's where it gets incredibly exciting. Options provide leverage, one of the most powerful concepts in finance. Let me give you an example. Say Amazon is trading at $3,000 per share. To buy just one share, you need $3,000 cash.
Right, which is quite a lot for many investors.
Exactly. But with options, you could control the same amount of Amazon stock for maybe $150 to $300 through a call option. That's using your capital 10 to 20 times more efficiently. And if Amazon goes up 10%, your option might increase 50 to 100% in value.
That's impressive leverage, but doesn't that increased reward come with increased risk?
That's where strategy comes in. Options give you versatility that stocks simply cannot match. With stocks, you can only profit when prices go up. But with options, you can make money when markets go up, down, or even sideways.
Sideways? How can you profit when prices don't move?
Through strategies like selling iron condors or calendar spreads, you can literally profit from time passing and volatility decreasing. It's like getting paid while others are waiting. Fascinating, isn't it?
That does sound useful, especially in flat markets when my stocks just sit there doing nothing.
Precisely. And let's talk about protection. Options were originally designed as insurance. You can use puts to protect your stock portfolio against market crashes, like an insurance policy for your investments.
So I could keep my long-term stock investments, but use options as a hedge against downturns?
Exactly. Instead of panicking and selling your stocks during corrections, you can use put options to offset losses. It's like having your cake and eating it too.
But options seem so complicated with all the Greeks, delta, theta, gamma, vega.
The Greeks are your friends, Sarah. They're like the dashboard of a sophisticated vehicle, giving you precise measurements of different risk factors. Once you understand them, you gain extraordinary control over your investments.
I guess that does give options traders an edge over regular stock investors who might not have those tools.
Absolutely. And don't forget income generation. With strategies like covered calls or cash-secured puts, you can generate consistent income from your portfolio that far exceeds typical dividend yields.
That's interesting. What kind of returns are we talking about?
Well, dividend stocks might pay 2 to 4% annually. Well-executed option strategies can generate 1 to 3% monthly. That's potentially 12 to 36% annualized. It's like converting your portfolio into a rental property that pays you every month.
Now I'm starting to understand your enthusiasm, Professor. But what about the learning curve? It seems steep.
The learning curve is the price of admission to this financial wonderland, Sarah. Yes, it takes effort, but the rewards are extraordinary. And that's precisely why we created this podcast, to make options accessible to everyone.
So, for our listeners who are just starting out, what would be your number one piece of advice?
Start small. Paper trade first. Learn one strategy thoroughly before moving to the next. and always understand your maximum risk before entering a trade. Remember, options are tools, powerful tools that require respect and knowledge.
That makes sense. I think I'm ready to start learning more about options trading now. Could you walk me through a real-world example of how an option strategy might work?
Absolutely, Sarah. Let's go through a concrete example that our listeners can visualize. Imagine company XYZ is trading at $100 per share. You've done your research and believe it will rise to $120 within 3 months, but you only have $1,000 to invest.
So with stocks, I could only buy 10 shares, right?
Precisely. But with options, you could buy call options with a 105 strike price expiring in 3 months for perhaps $3 each. Each option contract controls 100 shares. So your $1,000 could buy roughly 3 contracts controlling 300 shares. That's the power of leverage.
So if the stock reaches 120, those options would be worth at least $15 each, right? That's $15 minus the 3 I paid, so $12 profit per share on 300 shares.
That's $3,600 in profit from a $1,000 investment, a 360% return. Compare that to buying 10 shares of stock, which would give you only $200 profit, or a 20% return. Of course, if the stock price never reaches 105, your options could expire worthless. But remember, your maximum risk is capped at $1,000.
That risk-reward ratio is incredible when you put it that way. And that's just one basic strategy. Options trading is like having an entire arsenal of financial tools. Let's talk about another powerful concept, selling premium.
Selling premium? I thought we were buying options. Options trading isn't just about buying, Sarah. One of the most powerful concepts is becoming the house rather than the gambler. When you sell options, you collect premium up front. Statistically speaking, most options expire worthless, which means sellers often win.
But doesn't selling options have unlimited risk? That sounds dangerous.
An excellent observation. When selling naked calls, yes, the risk is theoretically unlimited, but there are safer ways to sell premium. For instance, with cash-secured puts, you set aside the cash to buy shares at the strike price if assigned. It's like getting paid to place limit orders on stocks you wanted to buy anyway.
So if I want to buy a stock at a lower price than it's trading for now, I could sell a put option and get paid while waiting.
Exactly. Let's say you want to buy that XYZ stock, but think $100 is too expensive. You'd prefer $90. Instead of placing a limit order and waiting, you could sell a $90 put option and collect maybe $2 per share in premium. If the stock stays above $90, you keep the premium as pure profit. If it drops below $90, you buy it at $90 as planned, but effectively at $88 after accounting for the premium you collected.
That actually sounds like a win-win situation if you're already planning to buy the stock.
It's a beautiful strategy that most retail investors simply don't know about. And here's another gem, covered calls. If you own 100 shares of stock, you can sell call options against them, generating monthly income. It's like collecting rent on stocks you already own.
How much income are we talking about?
Depending on the stock's volatility, you might generate 1 to 3% monthly by selling calls slightly out of the money. That's potentially 12 to 36% annualized extra return on positions you already have. It's like turbocharging your portfolio.
But you're limiting your upside potential, right? What if the stock skyrockets?
Another astute observation, Sarah. Yes, with the covered call, you cap your upside at the strike price. But remember, you're still profiting from the stock's rise up to that strike, plus the premium you collected. Many investors are perfectly happy with a capped 10 to 15% return over a few months plus premium, rather than hoping and praying for a home run.
What about more advanced strategies? I've heard terms like iron condor and butterfly spread.
Those are beautiful, sophisticated strategies for more experienced traders. An iron condor, for instance, combines 4 different options and profits when a stock stays within a specified range. It's like building a profit zone and getting paid as long as the stock doesn't move too far in either direction.
That sounds like creating your own custom risk-reward profile.
Precisely. You're getting it, Sarah. That's the magic of options. They let you customize your risk-reward profile with surgical precision. No other financial instrument gives you that level of control.
You know, when I first started investing, I was told options were just for gamblers and speculators.
A tragic misconception that keeps many investors from these powerful tools. Options were originally created for hedging and risk management. Yes, they can be used speculatively, but in the hands of an educated investor, they're sophisticated instruments for generating income, providing protection, and enhancing returns.
How about using options for portfolio protection? You mentioned that earlier.
Protection, perhaps the most underutilized aspect of options. Imagine you have a $100,000 stock portfolio. You're concerned about a potential market correction, but you don't want to sell and potentially miss further upside.
That's a common dilemma.
For perhaps 1 to 2% of your portfolio value, $1,000 to $2,000, you could buy put options that act as an insurance policy. If the market drops 20%, your insurance kicks in, offsetting much of the loss. If the market rises instead, you lose only the premium, a small price to pay for peace of mind, similar to how you pay for home insurance hoping never to use it.
That's actually a really practical application.
It's portfolio insurance, Sarah. And during major market events, earnings announcements, economic data releases, elections, options can be especially valuable as short-term protection.
What about using options to generate income during retirement? Could that replace dividend investing?
A fantastic question. Many retirees are discovering that systematic option selling can generate more predictable income than dividends. Imagine owning stable blue chip stocks and selling covered calls or cash secured puts on them monthly. You could potentially generate 12 to 24% annualized income, far exceeding typical dividend yields of 2 to 4%.
That could make a huge difference for people living on fixed incomes.
Absolutely. And in today's low interest rate environment, these strategies have become increasingly important for income-focused investors. It's financial empowerment through education.
I think I'm starting to see why you're so passionate about options trading now. It really does open up possibilities that simply don't exist with traditional stock investing.
You're catching the vision, Sarah. Options trading isn't just a different way to trade. It's a paradigm shift in how you view markets and risk. It transforms you from a passive investor hoping for good returns into an active investor engineering your own outcomes.
So for our listeners who are ready to take the next step, what resources would you recommend?
Start with paper trading on platforms that offer robust options tools. Read foundational books like Options as a Strategic Investment by Macmillan. And most importantly, join us for our next episode where we'll break down call options in meticulous detail. We'll cover strike selection, expiration dating, and exactly when to use them for maximum effect.
Thanks, the options blueprint. And thank you all for listening to Options Trading Mastery. Don't forget to subscribe for more educational content that could transform your investment approach.
Before we go, remember this. The world's most successful investors don't just pick stocks. They craft positions using all the tools available. Options are your gateway to that sophisticated approach. See you next time, option enthusiasts. The market awaits.